because if you, this is an old saying, I know, but if you fail to plan, then you're just planning to fail.
The land of Arcadia.
Well, hello there, my friends. Chris Marcus here with you on Thursday, May 31st, 2018 for Arcadia Economics. And I'm excited to have a special guest on today, David Moadel from Looking at the Markets. Has a great YouTube channel and has been doing a lot of interviews, which I've caught over the past couple months. Really impressed with your knowledge of the markets and really what you're sharing with folks. So it's great to have you on here today. Welcome, David. How is everything going, my friend?
Oh, it's great. Thank you so much for having me on. I'm a fan of your program. And for people who are watching this program right now, make sure you subscribe, all right? You don't want to miss anything. All right, so I'm looking forward to this interview, talking about the markets, what's going on, and let's do it.
Yeah. So for people who might be hearing you for the first time, can you give us a quick rundown of your background and how you came to know more than just about anyone that I've worked with on Wall Street or heard of in the Federal Reserve?
Wow, Chris, you're way too kind. Yeah, my name is David Moadel, and if you want to find me, I have over 400 free YouTube videos on my channel called Looking at the Markets. Or just find me, just Google it, YouTube it, David Moadel, M-O-A-D-E-L. And I've had the pleasure of interviewing so many amazing people, some real rock stars in the financial community and in the YouTube community, people like Cliff High, Lynette Zhang, Gregory Mannarino, people like that, options expert, John Carter, the Fibonacci queen, Carolyn Borodin. I mean, it's just amazing the people I've gotten to speak to. And they were nice enough to just come on my YouTube channel. And these are people who've been on CNBC and MSNBC, all over the place. So I've been in the financial and educational spheres for a long time, over 20 years. And I have a master's degree in education, and I'm a former 5th grade teacher. That's right. I used to teach. Yeah, I used to teach 10 and 11-year-olds, and that seems like a former life now, but it really was gratifying and fulfilling. I got to teach at the high school level as well as college, and now I help people put together their financial plan, because if you, this is an old saying, I know, but if you fail to plan, then you're just planning to fail. And so people can contact me anytime. My email address is davidmoadel, M-O-A-D-E-L, @gmail.com. Or, just check out my YouTube channel. And for example, I just put up a long webinar over 40 minutes on cannabis picks, my favorite cannabis picks right now. And we could talk about that.
Are you getting much into the Canadian ones? I know Casey Research and a couple other folks are big on, because I guess their legalization goes soon. How's that looking?
Yeah, supposedly, prospectively, Canada Day, July 1st of this year. But yeah, these things don't always work out as planned. You know how governments are. So, yes. And things don't always work. Also, keep in mind, for everybody saying, oh, it's coming, let me just put all of my capital into pot stocks right now. Well, remember, here's a rule that I tell my students and my clients. Okay, if you know something's going to happen, and I know it's going to happen, you know who else knows? Everybody, okay? Everybody knows, and so it's priced in, all right? It's baked into the pie already. You need to get in, to quote Warren Buffett, one of my inspirations, you got to get in when, you buy when there's blood on the streets. Buy in the red, sell in the green, as my friend Rich from Rich TV Live likes to say. Mm-hmm. So I don't like to buy when there's a lot of hype going on. I like to buy the sleepers, things that people are sleeping on, not thinking much about, all right? So the idea is not to get in at the top, because you know what happens when you buy at the top. As soon as you hit that buy button, it's all, you ever get the feeling they're watching you and just waiting for you to hit that buy button so they can have a nice steep decline, right? Stairs up, elevator down. So you have to time it correctly. I would say buy the dips, and I'm not a licensed or registered investment advisor. I cannot tell anybody what to do. Nothing in this video is investment advice or suggestions. But I'm telling you, for me, I prefer to buy the dips. I like to buy something that is in an industry that I believe in, such as the cannabis industry. I think it has huge potential, but I don't buy it when there's massive hype and when everybody else is buying it. All
Right.
right. That's just my personal philosophy on it.
Mm-hmm. So, based on all the wild things that are happening in the world, certainly there's the cannabis stocks,
Mhm.
fascinating U.S. bond market, an Italian bond market that had an interesting week. Where, in your opinion, do things stand? Should people be looking and thinking about, and maybe an overview, and then we can drill down on a couple particulars. I'm particularly excited to ask you about the silver market, one of my favorites, but
Sure.
um,
Yeah, well, we could start with bonds. I mean, yeah, we had this Italy thing, and then the next day, as everybody was panicking, what happened the very next day? The market came right back up. I'm talking about the U.S. equities markets here.
mhm,
Came right back up and more. Okay, another head fake, another reason for fund managers to sell and then to buy right back. And yes,
mhm,
the markets are shaky today, but one day, I don't base my investment strategies on one day of price action.
right,
A lot of people probably did. A lot of people probably went short a couple days ago, the markets, the indices, and they got hurt the very next day. And we saw some short covering, and the market will head fake you. And so you've got to look at the bigger picture. Let's look at the bigger picture. What happened in the summer of 2016? Brexit scare. Oh my goodness. 2 days, maybe 3 days of downward pressure on stocks. Oh my goodness, sell everything, sell at the bottom. That's what a
right,
lot of people did. Okay, if you're going to let a couple days of pressure, a couple days of downward price action affect your mood, your emotions, and your investing or even just short-term trading strategy, then you don't have a plan in place. Not a good one. And that's why I help people. I help
well,
people to look at the bigger picture, right? And so what we're seeing now, we saw one day of downward price action, and a lot of people freaked out. And when you can control your emotions and realize, you know what, these are fund managers head faking people, it's a reason to sell and then buy back. Fund managers love it because they make commissions. Market makers love it because they make commissions.
yeah,
They make money on the bid ask spread every single time. Don't get head faked. Not to put down Italy as an economic influence, but if England pulling out of the Eurozone in 2016 wasn't enough to cause a massive stock crash, do you think Italy threatening to do that is going to cause a stock crash? Come on, people. Put your heads on straight, control your emotions, have a plan.
yeah. It's funny you mentioned that because as you were saying it, again, I'm not a technocrat governor in the Eurozone, although it always seemed like just if they leave the club, I didn't quite ever grasp how that has to be impending economic Armageddon.
Right.
Although perhaps even better than that, I love what you just said about the emotions of it.
Yeah.
And I say this coming as a guy who was the angry trader on the New York Stock Exchange about 10 years ago. And it's interesting. Have you ever read any of those Jack Schwager Market Wizards books? Where he,
Yeah, I've heard of it. Haven't. I'm not too familiar with that. But here's the thing, and being on the trading floor, I'm sure you have a different perspective on this. I mean, I tend to come from the perspective of a retail trader. People email me every day saying, what do I do? How do I play this? Where do I put my money? And again, while I cannot tell people what to do or what not to do, again, if you have a long-term perspective, then these things are just noise. I believe that's
right,
what you were
right.
alluding to.
Mhm.
And being on the trading floor, maybe you could tell me you probably have seen this so many times that doesn't even faze you anymore. Would that be accurate?
It took a while to get there. Really grateful that now at this point, after leaving the trading floor, learning to meditate and also be healthy in life, which is,
Yeah.
there were a lot of people on the trading floor that made massive sums of money, yet you probably wouldn't want to be around them and they didn't seem very happy.
Hmm.
And, I think understanding the markets certainly is important. You see which way things are going, yet what all of these folks that Jack Schwager, he goes out, interviews really successful traders, and they all had their individual system and way of doing it, yet what was the constant theme was risk management, not making decisions, kind of like if you hear poker players go on tilt, they take a bad hand and then it just changes their decision making. And it's interesting when you were mentioning your background as an educator. I'll bet that's really helpful because often those are the more important things than being able to do the numbers, right?
Yeah, that's huge. When I assist people, oftentimes they'll ask me to tell them what do I buy? Tell me what to do. Well, you could either give somebody a fish and they eat for a day, or you can teach somebody to fish and they eat for a lifetime.
Right.
And no, I didn't make that up. Okay, but I won't take credit for that one. But yeah, so you've got to understand, first of all, we can go back to the bond market. Personally, I believe that bonds, again, not telling people what to do or what not to do, but if you think about trying to play bonds as a long position, I would recommend against it now and pretty much forever. The bond market is toxic. Yes, okay, so yields went down from 3% to 2.75 or so, then up to 2.85. It's flopping around based on, it's so sensitive to news right now. Yeah. And with leadership in the United States and elsewhere, that's making very big pronouncements on almost a daily basis, whether it's on Twitter or wherever. We've some people call our president the tweeter in chief. Okay. And again, bonds are not toxic because of any particular president. Bonds were toxic when we had Democrats as president, or whether we had Republicans in the White House. This is not a political statement. What it is a statement against bonds. We've had inflation. We've had the government printing money like there's no tomorrow for a long time, regardless of who is in the White House and who is in Congress. Yeah. And so inflation is one of those forces that if you are long bonds, if you own bonds, that's going to hurt you. Inflationary forces are going to put downward pressure on bonds. I wouldn't be surprised to see them crater massively throughout 2018 and beyond. Another pressure, another continued pressure on bond yields is going to be the fact that there's normalization of interest rates. We had ZIRP, zero interest rate policy. In some regions of the world, we had NIRP, negative interest rate policy, which still blows my mind to this day. Okay.
Did you see there's actually, I found an essay on, I think it was the St. Louis Fed, forget the fella's name, but on the Fed website, he was just saying this is why negative interest rates are great and we should be looking at that. So it's not inconceivable that they're even planning that here.
Well, this is the upshot of this kind of policy since 2008, 2009. So what we have are retirees, savers, investors who've put some of their allocations into bonds. The old 60-40 portfolio allocation model that people have been, fund managers have been espousing for a long, long time now. Yeah, put 60% of your investable capital into stocks and 40% into bonds. Well, what's happened to people who purchased bonds when the yields were 5%, now at 3%, okay, went down to 1.37%. They got killed. They saw their investments crater, okay, and now it's coming back up. It's bound to come back up, and so it's just going to keep going. We've got normalization. We couldn't keep coupon rates, bond yields at 1% or near 1% for very long. It just doesn't work like that. Yep. And so to go long bonds now means you'd be a victim of money printing by central banks, not just ours in the United States, but across the globe. You're going to be the victim of interest rate normalization as coupon rates go back up toward where they call it normalization for a reason, back to normal rates, at least 5%. I'm sure you remember back in 1981 when coupon rates, bond yields for the 10-year were around 15%. That was something, huh?
Yeah, well, I think about that where if in 1980 to have some sort of equilibrium interest rate, Volcker raised it, it's either 20 or 21%.
Yeah, it was crazy.
And you look at how much bigger all the debt, how much more currency there is now. It's like, what would actually have to be the free market interest rate now, and we're going, we're 10 years later, and we're still at under 2%. And did you actually hear, this was interesting, I have weird hobbies, so every once in a while I'll listen to Jerome Powell or one of these guys give their presentation.
Okay.
And one of those in front of the banking committee or one of those congressional committees, and one of the guys asked him saying, you had mentioned before that in terms of normalizing the balance sheet, that your target is to get to 2.5 to 3 trillion in assets in the next 3 to 4 years. And I'm sitting there thinking, wait a second, we're at 800 billion before Lehman Brothers blows up. We go over 4 trillion now, and somehow normalization is now at 3 trillion, which, I mean, that's like $2 trillion of stealth QE they didn't tell anyone about.
Yeah. Did you ever go to that website? I think it's called the Debt Clock or the World Debt Clock, something like that.
Oh, yeah.
Where
I love that one.
See the debt just increasing exponentially every day. It blows the mind. So that's an interesting hobby you have, listening to Jerome Powell. It could have a detriment to your sanity, but okay.
A little bit.
But again, we're not picking on any particular administration. Yellen was no better, okay? Right. And neither, Paul Volcker actually wasn't that bad. He had some guts. I have to give him a little bit of credit. Pretty much everybody after that has just been so accommodative. They're helping the banks. They're not helping you. They're not helping me. They're not helping your audience. Your average Joe, average Jane, retail trader, investor, your saver, your retiree or near retiree, 401ks, 403bs, just everybody's investments, the 60-40 model that is being espoused. I personally don't buy into it. The promise that bonds are risk-free, they call it the risk-free rate. Right. It's not risk-free. Again, I see them cratering soon enough. Instead, if you want a better allocation, consider, and you touched upon this, precious metals. Physical, yes, sure. Yes. That way, it's not paper, it's not virtual, it's the real deal. Okay, you have it in your possession. There are disadvantages to that. You have to. It costs money, generally speaking, to ship it, to store it, to guard it in some form or fashion. Okay, you don't want to just keep it in your house, probably. Right. And then when you resell it, you might take a bit of a hit there in terms of you may not get exactly the spot price. All right. Right. But right now I'm liking silver because the gold to silver ratio recently went above 80. And that's happened 4 times since the United States went off the gold standard in 1971. So it's kind of a rare thing. And after that happens, silver tends to outperform compared to gold. So what does that mean? Does that mean you put all of your portfolio into silver? No, you don't put all your portfolio into one thing, no matter what it is. But what people can consider doing is, if they already have gold and silver, perhaps lighten up on the gold a little bit and replace it with silver. Yeah. That way you're not reducing your precious metals holdings altogether. You still have the same amount. It's just a little more on the silver side, a little bit less on the gold side, because the gold to silver ratio, which not enough people watch, by the way, it tends to revert to the mean, as do most things. It tends to go back to 50, but again, this is not overnight. This happens within months and probably years. But if you have a long-term outlook, which I recommend, pull back those charts, okay? Quit day trading so much.
Yes, thank you.
Nothing against day traders. I love the day traders. I coach and I help day traders, okay? But even for the day traders, I recommend you pull back the charts. At least look at the weekly candlesticks, all right? If not the monthly as well. Get the big picture, know where you are. Even if you're a scalper, you can benefit by looking at the big picture as well.
Mm-hmm. Yeah, and actually, it's interesting. I know Miles Franklin, who I write for, they actually have a swap right now where people do have gold and looking to exchange that for silver. Yeah. Give Andy Scheckman a call over there.
Sure.
So I guess you're of the perspective, I think I've heard you mention before that you would expect both going up, although just on a percentage basis, the move would be more extreme in silver with some potential more extreme downside, but does that sum up what you're seeing about right?
Yeah, I mean, so we've got gold struggling at around the 1300 level per ounce, silver in the 16s where it's been for a while. Very recently, in the short term, you've had that consolidation, the sideways chop in both precious metals. But I don't expect gold to stay at the 1300 level for very long. You got the squeeze and you got the release, and these are options traders terms, but you can apply it to precious metals as well. The longer something goes sideways, as silver has been, and gold to a lesser extent has been, when something is just consolidating, going sideways, fund managers will not allow sideways action forever. Market makers will not allow that forever, because they don't make a whole lot of commissions off of that, off of sideways action. So the longer, again, I'm full of cliches today, but the longer the base, the higher in space. I'm sure you know that one. Right. Now, so after the longer the sideways action, the more buildup there is, and the more explosive the move can be. Again, options traders know this because, oftentimes when you have that long sideways action, that's a time to sell straddles, sell strangles, things like that. But in the precious metals sector, I expect the movement to be upwards because I'm bullish on that. And so I don't see any reason not to have at least some precious metals holdings, hey, better than bonds. Okay.
Right.
Yes. Now, pulling back the chart, as I love to do, and as I've gotten myself in the habit of doing, so the highest gold price was in 2011. It was around 1900. And then we had a bear market. And I love the word bear market. Bears sound fuzzy wuzzy, right? They sound gentle. But anybody who's ever gone camping knows that they're not fuzzy wuzzy and gentle, are they?
Okay. Sure, they're not.
Yeah. And so what you had was a horrendous bear market, started to relax around 2016. And we've had not exactly sideways action, but chop. Let's call it chop since then. You can either just find a range there in that chop and just kind of be a bit of a scalper, if you will, just to buy at the bottom of the range, sell at the top of the range. But if you have a long-term perspective, like I tend to have, you can realize that, again, it's basing, it's consolidating. The sellers, the panickers seem to have just dried up. And I do believe that gold is one of the greatest stores of value that there is. I mean, gold, silver, these have been around for 5,000 years as a commodity. All right. So why not get something that is going to be worth something, even if the what hits the fan. All right. You'll have it in your possession. Another way to play it is through gold and silver miners, but you have to know what you're doing. And I help people with that. Right. I also happen to work at portfoliowealthglobal.com. They have a newsletter over there. It's free. And Tom Beck, who is the chief researcher, he puts out free reports there about, he'll give his favorite picks on gold miners, silver miners, blockchain, first movers in that industry, cannabis picks. Again, that's something to consider as a resource. I think it's an excellent resource. But whatever you do, find a mentor. If you're going to get into whether it's precious metals or stocks, mining stocks, whatever it is, and miners are a great way to play what I believe to be the coming boom in gold and silver. It's going to have bigger moves than the underlying commodity itself. I mean, let's face it, gold and silver, they're not going to be 10 baggers in the next year. Okay. But some mining stocks will be, some of them, but you have to choose carefully, because while they can go up a lot, they can go down a lot. And so have a mentor, have somebody to help you through the process and to plan first of all, where to get in, where to take profits, and what to do when it goes against you, because sometimes it will.
Yeah, and actually that's, I love what you mentioned about the mentor. I was actually listening to an audio set by a fellow named Kevin Trudeau, and goes into a lot of just the value of anything that we want to do. If you go find someone who's doing it successfully, and find out what are these guys thinking about? What are they? So again, that's great that you offer that service. And how would someone Google if they Google looking at the markets, if they wanted to find that page to look you up? Just
Sure.
Google David Moadel, look at the markets, and they could find that.
Absolutely. Thank you for asking. Yeah, just go to Google or YouTube, David Moadel, Moadel, one L,
Mhm.
and you'll find me. That's one way. Looking at the markets with David Moadel is the name of the channel. Over 400 free videos on everything from you got your pot stocks, you got your bond market, your gold and silver, and other precious metals too. Don't forget, the platinum, the palladium,
Yep.
even the zinc is. You can play that as well, and I can show you how. And as
We'll
well as
get those links below on the interview, so if anyone's,
very cool.
you'll be able to see that down there
Yep.
by the time you're watching.
Awesome. And davidmodel.blogspot.com. That's my blog, and it's just a page where you can find me. That's my portal there as well. Again, before you do that, make sure you subscribe to Chris's channel right now. Don't forget it. Hit that subscribe button wherever you see it, because Chris, you are a resource. You're not an alternative news source. You should be people's primary news source. Okay, not the CNBCs and the MSNBCs of the world. You should be coming here first.
Well, that's kind of you to say that, and it's nice. This is more fun than I remember having on the trading floor, where especially, I listen to a lot of folks out there. I figured I download from YouTube, put it on double speed, and I get through a lot of content, but it's nice hearing folks like you that, are not just that we're seeing the same things, or that the point is to see the same things, yet, especially after the housing market crashed, I started reading Austrian economics and realizing a lot of what I'd learned at Wharton, a lot of what I'd seen at the banks in these shops was not genuine. I mean, we've seen scandal after scandal, year after year, and it's almost, all right, what has the Fed ever gotten right? Why are we continuing to listen? Did you ever happen to catch any of those? I guess Peter Schiff, back after the bubble collapsed, he had those videos where you'd see what Bernanke was saying and then what Schiff was saying, and eventually, which I love about what you're doing and what you mentioned before, where, you can hand your money blindly to people that, and hopefully you find the right guy. I would suggest you, David, as a person that is someone, although again, I like that you're not saying do this, do this, do that, but giving people the ability so that they can make their own decisions, which I think leads to a lot greater success.
Yeah. People ask me all the time, when are you going to put out, they say, David, when are you going to put out an alert service, a signal service? I may do that, but even then, I still have the heart of an educator. I still want people to understand why I'm choosing this over that. And then they still have to make their own decisions, because there's always risk. It's interesting. I talk about so many things, cryptocurrencies on my channel. Again, like I said, marijuana stocks. We can go anywhere you want to go with this. Whatever it is, my principles are the same. Buy what everybody else is sleeping on. Okay. Don't. Yeah, it's so funny. They're the so-called momentum traders and investors who will buy something after it went up 8, 9, 10 days in a row.
Yes.
Okay. And sometimes they're right. That's the thing. It'll go up 1 or 2 more days and they'll say, see, I told you so. Don't fight the tape, right? Okay. The trend is your friend. Cool. I get it. Congratulations. You made money. You know what I say to them then? Okay, you made profit on those 1 or 2 days of upside price movement. Imagine if you had gotten in at the bottom 8, 9, 10 days ago.
Right.
When everybody hated that stock or cryptocurrency or commodity or, whatever it is. All right. So the time to get in is before everybody else. When there's that old saying, when your shoe shine boy is talking about a particular stock, it's time to sell. Or if they're talking about buying stocks in general, it's time to sell. Then they change it to the cab driver. Now it's the Uber driver. Okay. If your Uber driver is telling you to buy something, it's time to consider selling it. All right. So I believe in being a contrarian, and that's just my own personality. I've been like that since I was a kid. When I saw everybody else zig, I wanted to zag. That's just how I was.
Mm-hmm.
it didn't enamor me of, with the teachers and the principal of the school, but, wanting to do what everybody, wanting to be a nonconformist. But as an investor, as a trader, it will benefit you if you have a plan, if you have a great coach or mentor, and if you plan ahead of time. Again, entry price, stop loss if you choose to use them, profit target. If you know those before you get in, before you hit that buy button, then you have nothing to worry about. You don't have to lose any sleep about any of your trades or investments because you've accepted the risks beforehand and you know how much you're going to make if things go right.
Yeah. And it's interesting because, and not to say that there aren't different ways to trade and if people can be successful doing things, by all means, yet there is a naturally inherent bias where if you're buying after other people have bought, and the concept is to buy low, sell high, it's kind of a little bit against the trend. Whereas, again, I like that you pointed out the mining where silver and gold are trading at essentially what it costs to get it out of the ground. So that was one of the things that always made me feel comfortable, where I'm a believer that I do think these markets are heavily manipulated with a lot of short paper that I don't think the banks will be able to deliver. Even, you mentioned before how the last couple of years have been rough, yet, if you bought gold in around 2001 when it was 200, 250 bucks an ounce, hey, if you bought it when it was 1900, yeah, you're down on that. But still over the longer term, like you suggested, we're up 5-fold since then. So
yeah, pull back the charts, people. All right. When you go on Stock Twits, and I like Stock Twits, I'm on there almost every day. Okay. If you're on Twitter, again, I like Twitter. You'll see whenever something goes up 8, 9, 10 days in a row, is everybody bearish like they should be, or selling, or taking profits? No. What do you see? You see all the bullish green signs lighting up on everybody. When a good company or good commodity that consistently comes back up, when it goes down 5, 6, 7, 8 days in a row, is everybody bullish like they should be? No. You see all the red bearish signs flashing. You go in the Facebook groups. You go wherever you go into chat rooms. You look at newsletters, and you can drive yourself crazy. So sometimes it's not a bad idea just to step away from social media for a little while, or step away from the television. The television, oh my goodness. Don't you love how CNBC trots out the markets in turmoil graphic? It's that same graphic. You ever notice that? Every time the markets go down a couple days in a row, or if it goes down, if the spiders, the S&P 500 goes down more than 2 points in one day, 2% in one day, markets in turmoil. And so what does everybody do? They sell, they freak out, they panic. Man, that's the time to remain calm. That's the time to think for yourself. If you just listen to everybody else, you're going to be a lagging indicator, and you're going to be a statistic. You're going to be one of those people that tries investing or trading, and like 90% of retail traders fail at it, unfortunately, and then quit. It's okay to fail at it, but then they quit. They never get back in. They blame the market. Market's rigged, whatever. The market's irrational. Yeah, okay, the market's rigged. Yes, it's irrational. Yep. That doesn't mean that you have to be irrational. Right. That doesn't mean that you have to give in to sentiment and be a lagging indicator or a lagging trader, okay? Look, I've made mistakes. We all have. I've traded out of anger. I've done revenge trading. I've done boredom trading. Okay. What I can do now is, now that I'm a little bit older and hopefully a little bit wiser, I can help people not to make those mistakes and to learn from my successes as well as my mistakes from back in the day. So that, there's the old saying, you're not a real trader until you blow up an account. Well, you don't have to blow up an account. If you get a good coach, get a good mentor, you don't have to be a statistic. You can be a success story.
And if you have a good coach and mentor, if you do have something that doesn't go well, how to handle that and learn from it is really incredibly important. Remember, that was something I remember reading about that in another one of those Jack Schwager books before I got to the trading floor. And some of the guys I've worked with, and it was always like everyone remembers their first big walloping.
Mm-hmm.
of which I still remember mine, which must have been mid 2007, trading options on Sallie Mae,
Okay.
which was a deal stock. And I remember I'd gone to the bathroom, I'd come back to my computer, and basically half of what I had made that entire year had instantly disappeared.
Mm.
And I remember being nervous, and then my boss came down, who very rarely came to that section of the floor. And again, the shop I worked for, they trained us very well. They said, you're looking at expectancy. You know, it's like a poker hand. You just keep making good decisions. And so it was interesting. It always meant a lot to me that rather than having some guy coming down screaming in my face, Paul was a really good man. And he said, hey, what happened? How is it looking? And I told him, and then he said, you're doing what you're trained to do. Just get it back out there and keep trade. And that was, especially in my first year as a trader, was a big step for me, having that support and encouragement, which I think you can get from a good coach and someone who understands these things, so that rather than beating yourself up and making more bad trades, you know, it's a science of probabilities. If you get someone to give you a 55-45 on a coin flip, as long as you make your bankroll small enough, you can take that emotionality out of there and you can have it in your favor.
Great points. Position sizing is everything. That's rule number one. Your number one job as a trader is not to make money, but to protect your capital. As Warren Buffett has said, and I know I keep quoting him, but he's an inspiration to me. Rule number one, don't lose money. Rule number two, see rule number one. All right.
Yeah.
So capital preservation comes first. I do receive a lot of emails. And again, people can email me, David Moadel, Moadel @gmail.com. And as we wrap it up here, just to recap, you know, bonds, no bueno. I don't recommend them. Consider precious metals. Consider not just handing your money over to somebody, you know, walking into a bank, walking into a Wells Fargo, Merrill Lynch, Bank of America. Here you go, fund manager. Take 1 to 2% of my portfolio holdings per year and underperform the S&P 500. Okay,
Right.
you know, that's not what I recommend, because they will. 8 out of 10 of those fund managers underperform. Just buy and hold S&P 500, and you're paying them 1 to 2% to do that.
Mm-hmm.
So I recommend finding somebody like Chris or like myself who can guide you through the process, can give you new things to think about, can help you select. You know, we're talking about stock selection, commodity selection, cryptocurrency selection, whatever it is.
Mm-hmm.
Filtering out the noise, knowing what your entry price is, profit target, and stop loss if you choose to use it, knowing these things beforehand, helping you to sleep at night better, helping you to become more profitable over time. And that's what it's all about.
Yeah, and before I let you run, any quick thoughts on the cryptos, which certainly an exciting asset class these days?
Yeah, absolutely. Okay, so Bitcoin, which is, as my friend Rich likes to say, the mothership. Okay, you ever notice that if you go on worldcoinindex.com or coinmarketcap.com and you look at all the cryptocurrencies, whatever Bitcoin does, everything else does.
Yep.
If it's a big move, if Bitcoin's flat, then you'll see a mix of reds and greens. But if Bitcoin is down a lot, it'll be a sea of red with a few exceptions. If Bitcoin's up a lot, it'll be a sea of green with few exceptions. So you should be following Bitcoin no matter what you're investing in the crypto space, or even if you're not investing in the crypto space, why not? So Bitcoin went up to almost $20,000, and now it's down to about $7,000, between $7,000 and $8,000. It's painful. The problem is that people bought at the beginning of this year, at end of last year, beginning of this year, when the hype was at a fever pitch. If Chris, if they had been listening to you, or if they had been, you know, one of my students or clients, they wouldn't have done that, because they wouldn't be in the habit of buying when the hype is at a fever pitch. Another instance of when your Uber driver tells you to buy Bitcoin, that's the time to probably take profits.
Right.
So people who bought in much earlier, people who've been watching it since 2009 and accumulating not long after that, they're just fine. Even at 7,000, even if it went down to 2,000, they would be just fine. So do I see it coming back up? Not in the short term, but eventually, yeah, it'll hit that all-time high again at some point. But you don't want to be a victim. You don't want to, you don't want to buy high. You want to buy low, sell high, and you got to know when to take profits. It's a painful lesson for people who bought, around January, February this year, December last year. It's a painful lesson. Hopefully you didn't mortgage your house. Like I saw a news report on somebody mortgaged his house, sold his house to buy Bitcoin with it. It's a lesson in position sizing. It's a lesson in buy low, don't buy, don't buy high, no pun intended for the cannabis buyers, and have a plan beforehand. Otherwise, you're just planning to fail once again.
Yeah, not the asset class to go margin it up on.
Ooh,
so,
yeah. Yep.
With that said, again, this is where certainly having a coach or a mentor like David comes in handy. So certainly I would recommend that. And you can find David at davidmoadel@gmail.com, or you can click the links below. And with that said, David, thank you so much for coming on, sharing all of your knowledge. It was great to get in touch with you. You're doing a great job out there. By all means, watch Looking at the Markets, the YouTube channel. I did catch your Cliff High interview last week, so you're doing great stuff. And thanks so much for coming on.
Thank you, Chris. I hope to be back soon. Thanks a lot.
Yeah, will do. Hit that subscribe button. We'll see you again soon, and talk to you later.